Hey everyone, welcome back to Corporate Decoder, the place where we might just uncover a shell game within a SPAC. And let me tell you, this report is a wild ride filled with more extensions than a rubber band factory and some truly eyebrow-raising financial maneuvers. Before we dive in, if you love getting the real story behind corporate filings and want to understand what all these numbers actually mean, make sure you hit that subscribe button and ring the bell. We also have a great community over on Discord linked in the description below. Come join the conversation. Alright, let's jump into the latest quarterly report from Integrated Rail and Resources Acquisition. CORP is a document that really highlights the challenges and complexities of special purpose acquisition companies or SPACs. This filing is essentially a check-in on their financial health and operations for the quarter ending the 30th of September 2025. Now, what is this company up to, you ask? They are a blank check company, meaning they were formed to find and merge with another company, a business combination as they call it. The key here is that as of this filing, they still haven't found that perfect match, or at least not one they've finalized. First off, let's clarify what an acquisition company actually does. Think of them as a company with a pile of money raised from investors specifically to go out and buy another company. They have a deadline to do this, or they have to give the money back. And that deadline has been a recurring theme here. This report shows a company that has been extending its deadline to find a target business multiple times. We see mentions of extensions pushing their combination date further and further out. It is like they're perpetually on the verge of a deal, but it never quite closes. Now let's peek at the numbers. On the balance sheet for the 30th of September 2025, we see total assets of $677,485. That might sound small, but remember, this company's main asset is the money they raised to find that acquisition. A huge chunk of that is in their trust account, which is where the IPO money is kept safe until a business combination happens. This trust account had $673,027 as of the 30th of September 2025, a significant drop from $3,237,676 at the end of 2024. This tells us money has been moving around, likely for expenses or redemptions. On the flip side, their total liabilities are $31,610,267. This shows a company that has taken on significant debt obligations. A big part of this is warrant liabilities and deferred underwriting fees, which are common in SPACs but still represent obligations. And speaking of deficits, the accumulated deficit is a staggering $31,329,103. This is basically the total losses the company has accumulated since it started. It is a common feature for SPACs, especially when they haven't found a business to merge with yet and are burning through cash on operations and extensions. Now let's look at how they are doing in terms of earning or losing money. For the 3 months ended the 30th of September 2025, they reported a net income of $5,995,512. That sounds great, right? But hold on. A big reason for that income is a non-cash adjustment related to warrant liabilities. They saw a massive $6,980,000 positive change in the fair value of their warrant liabilities. This isn't profit from selling a product or service, it is an accounting adjustment based on changing market values of their outstanding warrants. Meanwhile, operating expenses for the same period were $917,076. This is the actual cash they spent on running the company, things like legal fees, accounting, and administrative costs. For the 9 months ended the 30th of September 2025, the company reported a net loss of $5,562,621. This highlights the volatile nature of these SPAC financials, where a net income can be followed by a significant net loss depending on those accounting adjustments. Looking at the cash flow statement for the 9 months ended the 30th of September 2025, cash used in operating activities was $1,561,760. This shows the company is spending more cash on its operations than it is bringing in from its core activities, which for a SPAC is basically finding a business. On the investing activities side, we see $2,765,802 withdrawn from the trust account to pay redeeming stockholders. This means investors who bought into the SPAC wanted their money back. And on the financing side, they had $1,675,000 in proceeds from a note payable from a related party. This is essentially borrowing money from a connected entity to keep operations going. It is like borrowing from your uncle to pay your rent while you look for a job. Now for the crucial part, the going concern note, this section tells us if the company has enough resources to stay in business for the next year. And the report states clearly that there are factors that raise substantial doubt about the company's ability to continue as a going concern. They have less than 12 months to complete a business combination, or they have to liquidate. This is a critical warning sign for any investor. Interestingly, there is a mention of a crude oil supply offtake and processing agreement with Shell Trading US Company or Stusco. This suggests potential future plans or a target acquisition in the energy sector. It is one of the few hints at what they might be aiming for. The report also details a proposed business combination with Tar Sands Holdings the Seguin LLC, denoted as TSH Company. They've been very active with amendments to their merger agreement, extending deadlines and modifying terms. This indicates the deal is complex, highly negotiated, and still very much up in the air. A notable point is that their securities were delisted from the New York Stock Exchange, or NYSE. They fell below the market capitalization standard and now trade on the over-the-counter or OTC pink market. This usually means lower liquidity and less investor confidence. In their own words, management acknowledges the substantial doubt about their ability to continue as a going concern. They are actively trying to find a business combination, but acknowledge they might run out of funds and be forced to liquidate, which means investors could lose their money. They also disclosed a material weakness in their internal controls around calculating and paying funds from the trust account to redeeming shareholders. This is a red flag in financial reporting, suggesting potential errors or lack of proper oversight in a critical area. There is also ongoing litigation with Taya Energy Utah Logistics, LLC. This lawsuit adds another layer of uncertainty and potential financial strain for the company. Now let's put on my investor hat and look at this whole picture. Integrated Rail and Resources Acquisition Corp is in a precarious position. They have significant liabilities and accumulated deficit, and their going concern status is seriously in doubt. The income reported in the statement of operations is heavily influenced by accounting adjustments for warrant liabilities, not by actual business activity. This is typical for SPACs that haven't merged, but it can be misleading. The repeated extensions and the delisting from the NYSE are concerning signals. The proposed merger with Tar Sands Holdings II LLC is their main hope, but the delays and amendments suggest it is a tough negotiation. The material weakness in controls is also something to watch. Ultimately, this filing paints a picture of a SPAC struggling to find its footing and execute its core mission. The future hinges entirely on securing that business combination and navigating active litigation. It is a high-risk scenario for investors. Alright, that is our deep dive into Integrated Rail and Resources Acquisition Corp's latest filing. What is your take on their chances of finding a business combination or their overall strategy? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up. It really helps the channel. And of course, subscribe for more deconstructions of corporate filings. Don't forget to join us on Discord, linked in the description. Thanks for watching, and I'll see you in the next video.